The recession is real and picking up speed. The latest economic data or information provides mounting evidence that the collapse of the housing market and turmoil and chaos in financial markets have tipped the U.S. economy into a recession. And now the question is on the minds of consumers, business owners, and politicians. How deep is it going to be, and how long is it going to last? This week's report showing a 0.3% decline in gross domestic product has confirmed that the economy has shifted into reverse, with job losses rising rapidly and consumer confidence falling to levels not seen in many decades. The reversal appears to be now picking up speed rapidly. Although they say a recession is not official until a panel of economists determines when the economy peaked and began shrinking, many people believe a recession has been underway for months, if not actually years. We are now entering the harshest part of the recession, said the chief U.S. economist for IHS Global Insight. One reason for concern is that the figures released this week do not even reflect the October panic that swept through the global financial markets as the credit system virtually shut down. In other words, it's worse than it seems. The economy has deteriorated sharply since that time, particularly in October. And now, even as credit markets begin to pick up a little bit, we have to undo that damage. And that damage means that the economy is going to get worse before it ever gets better. The Federal Reserve and Treasury have stepped up efforts to get banks lending again, and the Fed this week made another, largely symbolic reduction in the interest rate target for short-term loans between banks. It's down to 1% now. In other words, they don't really have any left to cut. Congress is debating another economic stimulus package, including proposals to provide hundreds of billions of dollars for overdue upgrades to the infrastructure, to roads, water projects, and sewer systems. That investment will help, but probably will not be enough to offset growing gaps in dozens and dozens of state budgets. Those deficits will almost certainly bring a cutback in state spending and hiring, one of the last sectors of the economy to show growth. There simply is no easy out for the financial markets, the economy, or policymakers. The great American financial workout continues. Yes, these are all more signs. As businesses saw their credit dry up in September, the Fed stepped in to guarantee the so-called commercial paper that big companies rely on to manage their day-to-day cash flow. And, more recently, consumers are seeing the crunch spread to credit cards, which has begun to put a crimp on their spending. Thursday's GDP report showed that consumer spending, which accounts for approximately 70% of all U.S. economic activity, fell at least 3.1% in the quarter ending September 30th, the biggest drop since 1980. One big reason is that consumers have less money to spend. Job losses and plunging home equity have eaten into purchasing power. Investors have lost an estimated $2 trillion, at least, in retirement savings alone since the stock market embarked on a sickening plunge last month. Rising home equity and an expanding stock market were two of the key factors that fueled the economic expansion that began in late 2001. The reversal of those factors will make it difficult to get the economy back on track. Very difficult. In other words, all systems have become broken. Efforts to rescue the banking system have focused on building up capital and writing down bad debts. And now American households are embarked on the same painful process by tightening their belts. putting further pressure on consumer spending. So, it remains to be seen how long that process will take. Once again, all systems are becoming broken. This is going to be a very long, protracted retrenchment. The key is going to be that consumers have no choice but to cut back. People's standard of living is starting to slip. They can't get the credit that they're used to. And so, over the next few years, I think we're going to see a significant retrenchment in consumer behavior, said former Fed Governor Lawrence Lindsay. Consumers are also likely to cut back as long as they're worried about losing their jobs. The unemployment rate already has risen to 6.1% from just 4.7% a year ago, and is likely to rise even further. The jobless rate last peaked at 6.3% in 2003, hit 7.8% in the 1991-92 recession, and rose to 10.8% in 1982. The economy so far already has shed at least 760,000 jobs this year, and is still rising. Numbers for October will be reported November 7th. Just this week alone, American Express announced plans to eliminate at least 7,000 jobs, and Motorola said it would eliminate 3,000 jobs, among others. There is little consensus among economic forecasters as to how long this recession will last. They just can't seem to figure it out. A lot depends on how long it takes for home prices to stabilize. Well, they got further to go. News that the government is at work on a comprehensive plan to help reverse the rise in foreclosures could help the housing market a little. And once again, these are more signs. Through recession, countless natural disasters, and a major terrorist attack, there's been one constant in the U.S. economy. American consumers have bought more stuff in any given quarter than they did in the previous one. But now, not anymore. Personal consumption expenditures fell at a 3.1% annual rate in the third quarter. And the new information or data show that even before the financial crisis deepened in October, American households were being walloped to a degree that has no recent precedent. These are not normal times, and conditions, economists say, are almost certain to get worse before ever getting better. This is a major about-face in consumer spending. A big major about-face. We've had a drop in the value of houses and stock portfolios, a very weak labor market and getting weaker, and a tightening of credit. The market a week ago was reeling from fears about recession, has been more composed after a report that GDP fell at a rate of 0.3%. Many analysts and economists think the country is already in a recession. Yes, it's in a recession. It's been in one for a while, although the panel of economists that makes such determinations, well, they say it's probably going to get worse, yes, and that the economy will contract at perhaps a 3 or 4% annual rate in the final 3 months of the year. And in 2009, well, 2009 could very likely, well, I hate to say it, but it could be worse than this year. All the economists are starting to agree on one thing. Yes, and that be it. Anyway, these are all more signs of the end times transition days. Yes, a new age or a new era is coming. Real change is coming. Just look around.